famous general once said, "If your enemy is secure in his fortress, be patient and besiege him. This is the way to win without fighting." Now, why would he say that? Because sometimes the best strategy isn't to attack head-on, but to wait, to watch, and to strike when the time is right. I see so many people making financial decisions out of fear or greed. And this is often the worst thing they could do. Being fearful when everyone else is greedy can be one of the most profitable moments in life. So don't panic when others are freaking out, because this is when opportunities present themselves. In this video, we will discuss 3 simple steps to help you stay calm while the world panics. If you're new here, welcome to the channel. We make investing and trading easy through quality education. Now let's get started. The first step is to understand the psychology of the market. The market is driven by people, and people are emotional. When people are fearful, the market drops like a stone. When people are greedy, the market soars like an eagle. Fear and greed are 2 powerful emotions that influence the market, pushing it up and down like a roller coaster. Understanding this helps us navigate the market better. It allows us to separate our emotions from our investments, which is key to staying calm. Think about this for a moment. If the market is a reflection of people's emotions, what happens when these emotions run high? Let's start with fear. Imagine a scenario where a significant event occurs that shocks the market, something like a global pandemic or a financial crisis. This unexpected event triggers a wave of fear among investors. They worry about job security, business failures, and economic uncertainty. As fear grips the market, it becomes self-fulfilling. Investors start selling their assets to have cash on hand just in case they need it. But as more and more people sell, the prices of assets drop even further. It's a downward spiral. The more the price drops, the more people fear they might go down even further, and so they sell. This creates a snowball effect that can lead to a crash. Now let's shift to the other side of the spectrum, greed. Picture a scenario where the market has been on a steady decline and suddenly things take a positive turn. Economic data improves, businesses start recovering, and hopes for a brighter future emerge. This sudden optimism generates a sense of greed among investors. They see the potential for quick profits and rush to buy into the market. As demand for assets increases, their prices also rise, but this can create a bubble. As more and more people buy into the market, hoping to capitalize on the trend, asset prices become inflated. It's like a real estate boom where prices go beyond what the market can reasonably support. When the market reaches its peak, there's nowhere else for prices to go but down. This is when greed turns into fear, and the cycle often repeats itself. The key takeaway here is that the market's ups and downs are significantly influenced by the collective emotions of its participants. By understanding this, we gain insight into the driving forces behind market volatility and can better prepare ourselves to navigate through the storm. Now that we understand the psychology of the market, the next step is to educate ourselves. Education is the key that unlocks the doors to financial literacy. Without it, navigating the world of investing and trading can be like trying to read a foreign language. It's full of terms, concepts, and strategies that seem like a secret code. But with the right knowledge, we can decipher this code and make informed decisions. Think about it. If the market is a vast ocean full of opportunities, education is the lighthouse that guides our ship. It illuminates the path, helping us avoid the hidden rocks and shallow waters that can lead to financial distress. Investing and trading require a deep understanding of various factors such as market trends, economic indicators, and financial statements. Without this knowledge, we're essentially navigating the markets blindly at the mercy of the waves. Consider the following analogy. Imagine you're planning a road trip. You wouldn't set out without a map or any knowledge of the route, would you? Similarly, we shouldn't enter the financial markets without proper education. A little bit of effort in learning the rules of the game can go a long way in preventing costly mistakes. Fortunately, we live in an age where financial education is readily available. There are countless online courses, books, and articles that can teach us the ins and outs of investing and trading. It's within our reach to become financially literate. It's important to remember that no one can predict the market with 100% accuracy. Even the most experienced investors and traders make mistakes. However, with a strong educational foundation, we can minimize those risks and make more informed decisions. Staying calm in the face of market volatility is easier said than done. It requires discipline, patience, and a clear understanding of our financial goals. As we conclude this journey, let's focus on the third crucial step, which is to seek professional advice when necessary. Just like how a captain relies on a team of experts to navigate the ship, we too should know when to seek external help. In the world of finance, there are professionals who have dedicated their careers to understanding the markets and guiding investors. These individuals can provide insights and perspectives that we might not have considered. Think about it. When facing complex financial decisions, it's perfectly okay to ask for help. Seeking advice from a financial advisor or investment professional can provide clarity and direction. They can analyze our individual circumstances, assess our risk tolerance, and guide us towards suitable investment strategies. It's like having a personal coach who specializes in the financial markets. However, it's important to exercise caution when seeking advice. Not all financial advisors have our best interests in heart. Some might prioritize their own commissions over our long-term financial well-being. Therefore, it's crucial to do thorough research, read reviews, and ensure that the professional we consult is reputable and trustworthy. For example, if we're unsure about a particular investment opportunity, a financial advisor can help us evaluate the potential risks and returns. They can provide historical data, market analysis, and expert opinions to help us make an informed decision. Additionally, if we're confused by the wide range of investment options available, a professional can guide us toward those that align with our financial goals and risk appetite. By diversifying our investment portfolio, seeking professional advice is just one piece of the puzzle. Ultimately, the final decisions should align with our financial objectives and risk tolerance. We don't want to blindly follow someone else's advice. Instead, we want to use professional guidance to enhance our own decision-making abilities. Think of it as investing in our own financial education. In conclusion, staying calm while the world panics involves understanding the psychology of the market, educating ourselves, and seeking professional advice when needed. It's essential to recognize that market fluctuations are influenced by people's emotions, and that these emotions can drive prices to irrational levels. By educating ourselves, we can make informed investment decisions, avoid common pitfalls, and navigate the markets more effectively. Remember, knowledge is the key that unlocks the doors to financial literacy. And when we turn the key, we open up a world of possibilities. So keep learning, keep growing, and remember that even when the markets are unpredictable, your financial future is in your hands. Thank you for joining me on this journey. If you found this video helpful, hit the like button and subscribe for more insightful content. Until next time, happy investing and trading.